And right now we're going to jump over to our man, Teddy Kekstadt. We talk to Teddy every Wednesday at 40 past the hour. You can check out Teddy's outstanding Tiger Forex Report, folks. Weekly issues out every Monday, updates throughout the week when warranted. You get some webinars in there as well. It's only $97. You get a 30-day money-back guarantee. And don't forget, under the Services tab, he's got a couple of outstanding webinars, Capitalizing on Time with Calendar Stock Option Spreads and Japanese Candlestick Pattern Stock and Option Strategies. Teddy Kekstadt, we talk to you on interesting days, and today is Fed Day as we approach. Good morning.
Good morning.
So, this is the first Fed meeting that Chairman Powell, he's going to get asked questions about Trump policies. I don't know if that's where there's enough there, but we got quite a market, Teddy. You got, of course, the AI freak out this week, not really important on a commodity perspective, currency, but it is interesting. We see yields, we see the markets, and that's not even some of the risks out there for tariffs, but we got the dollar back above 108. What are you looking at in this market with so many variables in play right now?
Yeah, right now, it's a Fed week, so the sideways trade that we've had pretty much, especially interest rates came back a little bit. We've had a little, change in the dollar. The past couple of days, we're having, we're in that range. Last week we hit the extreme. We hit bottoms and highs on Friday or into Monday in most of the currencies, and this little pullback is normal for the Fed meeting. To be quite honest with you, I'm not expecting very much out of this meeting. Excuse me. I think that they're going to be Trump's only been in office for 2 weeks, so, there's a lot that's going on, but I think that what you're probably going to hear out of Powell is his take on what's going on so far and what he sees as coming out of the White House perhaps over the next month or so, and then probably give us some kind of take on where he thinks that's going to impact maybe their policy, if you will. So I think he's going to talk about some of the recent economic numbers. And I think what he's going to probably do is say that they're really eyeballing the CPI and the PPI and employment numbers moving probably for this month and next month before they really start to know whether they're going to cut again.
Nice, and I kind of agree with that take because, as you say, we've gotten some executive orders, but kind of the ones that matter, right? Even Trump throwing around the threats on day one in terms of that press conference, saying 25%, maybe what do you say, something coming February 1st, as in we're not even there yet, and I think that's a negotiation. So he's got some time, and we got unemployment at 4.1% right now. The market, if anything, is looking for cuts. I'm talking myself right now, but why would you be pressing to cut right now if you're at a 4.1% unemployment rate and, you can buy yourself a little time where the market is? Right. I always check out your outstanding Tiger Forex report. You had, whether you're talking about, what's the exact term you're using here? Bearish correction bands I was looking at in the dollar, and that was a nice little area, man. We've had some volatility, and we did get a bounce around that area. We're back 108.20, something like that, I think, this morning. What do you think about the dollar at this level as we're still pushing a little highs? But, man, a nice little bounce from 107 on Monday.
Sure. Well, a couple of days ago, we bottomed out in the dollar index, and that was a nice corrective pullback off of our highs. Remember, the dollar has been rallying for months. So, this little pullback coming into, the inauguration and then now the first Fed meeting of the year is kind of, not unexpected, if you will. We were talking about over the past 2 weeks that this easement probably back in yields would come into this meeting. Now, remember that we only have 3/4 of a point factored in. Now, we already know that there's another half point that should be coming this year. But the question is, how soon is it coming? And the market right now, I think, is kind of going with what we were just talking about, is that it doesn't think there's going to be a cut for quite some time. And then if it does, maybe when they cut the next time, or whether I doubt it's going to be this meeting. I think it'll be probably in 2 or 3 meetings. When they do cut, I think that's when you'll see a really good retraction in yields. Like if you're looking to refinance, I don't think you're going to see very much movement right now. But the next time they cut, there's going to be the expectation of at least one more cut. So the market should adjust back, meaning yields fall back again towards at least where they were, probably 4 or 5 months ago. So, and if that's, or excuse me, 6, 7 months ago. And if that's the case, that's when you'll probably start to see the refinancing going on. Until then, I really don't see it happening. So I think what you're really setting right now is kind of a range. Like we could bobble between the low, the low that was set in the bond market, the 10-year a couple of days ago, and then the high that was set back in the a couple of weeks ago. So you're looking at basically trading in, let's see, that would be a 106 to 110, a 4 to 5 handle range in the 10-year in the bonds. So that's a range trade, and that could actually happen for the next 4 to 6 months. So if that happens, you're not going to see very much action as far as interest rates, that's for sure. Now, currencies, that doesn't mean that they're not going to start to trend, because I think especially like the U.S. dollar yen, because of oil, I mean, oil is trading right now at $73 a barrel. That's right on our downside breakout level, and I think that we could easily come down into the 68 area. So like and that will put us into a correction band too, like you were just talking about with the dollar index, into the correction band. Like we bobbled into that, just pierced through it on Monday, and now we're just above it again. So that could be the basing, like that bearish correction band that I have there on the Tiger Forex Report. That could be basically setting the lower range support band, if you will, could be the next 4 to 6 months. So that means that we'll just see the interest rates bobbling, and also the dollar index bobbling in that area. Not exactly what currency traders and trend traders want to hear, but I think that could be actually a reality. So now that's just with fundamentals there.
And it's great stuff, man. I'm just going to dig even deeper because you're getting my mind going for sure. So if we go, because I agree with a lot of it, right? So let's say, there's no reason they have to go right now. I would agree, right? Where do we go maybe a few months in? When you say maybe going back to where we were like 6 months ago, are you talking about where we were maybe when you had the 10-year, where we were all the way in like September when we were at like 3.6 or 3.7? Is that where, when they start those cuts, maybe you might get that type of move? Is that what you're talking about?
I think so. So. Yeah, I think it's very, very possible. Absolutely.
And if you get, because I love the conversation of, if they're going to stay where they kind of are, maybe you get a little chop around where we are in the dollar. But, let's talk about once you get movement, maybe if we get, and I'm not even thinking, we don't even have to get back to, I get the 10-year up there. We were almost pushing 116, 115.23. But what if we start making those levels? Is that really where you could get a pullback in the dollar? Is it heavily correlated? Because it's so interesting, and you've walked us through. Sure. You could see yields pull back a little bit, or even to that degree, and I'm talking right now. But it doesn't mean the dollar has to crash with where yields are across the globe right now. How do you? I tell you what, Teddy, can we let that one hang and we take a break and come back? Does that work?
Sounds good. Absolutely.
Okay, because that one I'm trying to wrap my own head around, right? Like, because I agree, maybe we get this pullback in yields, but we've talked about it, man. American exceptionalism versus Europe, the competition of yields. What's going to happen to the dollar, folks? Stay tuned. We're coming back with Teddy. We'll finish this conversation. Don't go away. Welcome back, folks. S&P is off by about 15 points right now, or 0.25%, trading at 6,082. We're talking to our man Teddy Kekstadt. Head on over to the newsletter page, folks, at TFNN. Check out that Tiger Forex Report. And yeah, Teddy, so just to finish that conversation, what do you think if we do get that type of move in yields, that the Fed, nothing crazy happens, they give it a little time, They give us some cuts somewhere down the line this year. Yields pull back. What do you think about the dollar? I know you talked to us so many times, the relationships, whether it's crude, different currencies out there in the dollar. But where do you think the dollar might head if we get that type of action in yields?
Okay, so yields is only one component of where the dollar goes, or the dollar versus other currencies. So I think the index as a whole will be probably in a very wide range trade, like I said, for at least the next 4 to 6 months. However, that does not mean that the currencies necessarily aren't going to do what they want to do. Okay, so that means you're probably not going to see much of a reaction out of the U.S. dollar Swiss. That's probably going to stay in that kind of a range trade thing, even with the U.S. dollar Canada. However, the euro, I think it's still going to parity no matter what. I don't care if we cut interest rates. I still see the euro going down to parity sometime between now and the next 6 months. Their economy is collapsing in Germany and throughout Europe. So even if they don't do anything with their interest rates, like maybe they cut over there and we don't cut, that would be something that maybe would give them strength for a short-term possible little rally. But fundamentally, I think no matter what, their economy is collapsing in both the UK and throughout the EU. Poland is pretty much the only economy in the EU that's actually somewhat stabilized right now. So, and I would say that you're going to probably see some trends like the U.S. dollar yen, especially with crude. Crude gets down to 68 with the interest rates in a range trade. That means the U.S. dollar yen is going to continue to trend lower. I could see it below that 150 key, Bank of Japan level, over the next 3 to 4 months easily, especially if we see crude break another $5. So we'll see some trends in some of those currencies.
Man, that was an awesome roundup. That's why I asked the question, man. I appreciate you giving us your thoughts as always, Teddy. Have a great week. We'll talk to you next Wednesday, man.
You too. Happy birthday, little Tommy.
Thanks so much.